The government just made it harder for you to profit from property by increasing the seller's stamp duty from 3 to 4 years. In this video, we're going to analyze the impact of this cooling measure on the market and more importantly, how this affects you as a seller and as a buyer. You ready? Let's go! And before we begin, if you're new to the channel, please help us like and subscribe as you help out the channel a ton. So we're going to break down this video into the why, the how, and the what of this particular cooling measure. Why is the government doing this? The official reasons written in the papers and also the ones that's not written in the papers. How is this going to impact the market in the short term, mid term, long term? How is this going to impact you as a seller and as a buyer? Last but not least, and more importantly, what are some of the opportunities that's going to arise from this particular cooling measure and what can you do to capitalize on that? So this cooling measure came out of absolutely nowhere, catching everyone by surprise. Why? It's because most cooling measures are reactionary in nature. They come on the back of a sharp increase in the property price index the previous quarter. Take for example, the cooling measure in 2023 that saw an increase in ABSD rates that came on the back of a 3.3% increase in the private property price index the quarter before. Looking further back in 2022, another round of cooling measures came up on the back of a 3.8% increase in the private property price index. Now, if you look at the immediate 2 quarters before this round of cooling measures, we only saw a cumulative increase of just 1.3%. So now, why is the government coming up with this round of cooling measures at this point in time? What are they preempting? So before we dive into the reasons why, perhaps a very quick explanation of what exactly is seller's stamp duty and what are the changes. So seller's stamp duty, as the name suggests, affects only sellers and sellers who sell their properties within a stipulated period of time. And before the 3rd of July, sellers that sell their properties within 3 years are subjected to a certain form of stamp duty tiered, right? After today, which is the 4th of July, right, sellers that sell their properties within the first year of buying are subjected to 16% stamp duty on the sale price. And then how do they calculate the time? They always calculate from the day you exercise to the day your buyer exercise it from you. Okay, so first year 16%, second year 12%, third year 8%, fourth year 4%, and subsequently 0%. I've always liked how they done the seller's stamp duty because I much prefer that they do it this way as opposed to a straight up capital gains tax across the board. We also have seller's stamp duty to thank for effectively removing speculative demand from the residential property market, avoiding the wild fluctuations in prices that we used to see prior to its implementation in 2010 as seen in this chart done by the MAS. Did you know prior to the implementation of the seller's stamp duty, 1 out of every 3 transactions was speculative in nature? So the official reason given by the government for the adjustment of these cooling measures is, I quote, "In recent years, the number of private residential property transactions with short holding periods has increased sharply. In particular, there has been a significant increase in the sub-sale of units that have not been completed." Now, if you go by the precise definition from URA, the word completed over here means statutory completion. Okay, and that can potentially be 1 year after they actually collect their keys. And we have headlines like that to thank. While I agree with the government's intentions for increasing the SSD from 3 years to 4 years because it forces people to hold on to their properties for a longer period of time, hence slowing down the rate of increase in private property prices, what I'm not sure about is how effective this is going to truly be. But what we do know are certain facts. And those facts are the reasons why I think there's more than meets the eye as to why the government is implementing these measures at this point in time. So fact and reason number 1 is the reduction in interest rates. So reduction in interest rates has 2 ways of impacting property prices. And let's take a look at the first way. So this chart charts the changes in the 3-month SORA. It effectively tracks the changes in mortgage rates. As you can see, 1 year ago, in about April 2024, the 3-month SORA stood at about 3.6%. Today, it stands at just 2%. That's a 1.6% reduction. Now, what does this mean, right? This means that people can better afford to upgrade their properties, right? You're effectively looking, like for myself, almost just a short difference between when I took my loan at the earlier part of this year to had I taken the loan now, I would have had $800 savings for my particular loan. So easy to say, from last year to this year, there's significant savings on that note. This perception will make people more willing to make that upgrade. A second, more interesting way, unseen way of how this boosts the real estate market is the fact that stress test interest rates come off. Previously, stress test interest rates were capped at about 4.6%, 4.7%. Right, what this means is that you are limited in terms of how much loan you can potentially take from the bank. That has then been reduced to 4%. Effectively, this 0.7% difference in stress test interest rates, I've calculated it, gives everybody sort of a 8 to 9% bump on the potential budget that they are looking to buy. So you look at these two factors, right? Reduce mortgage rates, make you more comfortable to go for the upgrade. You can take more loan, giving you more affordability in terms of what you can look out for. All this will kind of boost demand in the real estate market. So the second way a reduction in interest rates will impact real estate prices is its attraction of cash from alternative investments. As we have seen T-bills fall off from a high of 4% interest rates down to below 2%, people are looking for alternative places to invest their cash. Now, how much cash are we talking about? Let's take a look at the Singapore household balance sheet. So this is the Singapore household balance sheet as of 2025 first quarter. We are looking at the currency and deposits row, and that stands at $670 billion. Now this is accumulation of all of our bank accounts together. To put things into perspective, okay, $670 billion. The overall value of all the HDBs add together, the worth of it is $679 billion. Private properties is $856 billion. Okay, so we hold almost as much cash as the value of all the public housing add together. The overall liabilities add together stands at only $384 billion. So if we take all the cash, pay down all the liabilities, we still have close to $300 billion cash left over. Now, this excludes, this $670 billion excludes shares, excludes CPF, excludes life insurance, all these things. It's more or less liquid assets, okay? And also comparing to last year, okay, the rate of increase of all this cash, right? As I like to say, Singaporeans have two hobbies, right? Save money and buy property. So how aggressively are we saving money? This number stands at just $623 billion 1 year ago. So in the span of 1 year, we have saved almost an extra $50 billion. So in summary, with the government expecting interest rates to come off, also taking certain cues from the US Federal Reserve, they do expect a surge of demand to come back into the private property market. And this adjustment of the cooling measures may be one of the ways they are trying to front run and preempt that increase in demand. So now to the second reason why I think the government is preemptively tweaking this cooling measure is because we are expecting to see a sharp increase in MOP supply. And for that, I'm quoting MND's Instagram page. So we are taking a look at this infographic on the MND's Instagram page, right? And indeed it states sharp increase in resale flat supply from 2026. So this year, 2025, the MOP number stands about 8,000, and that's likely going to increase and more or less double from the current number come 2028 at 19,500. So now you might be asking, so Alvin, how does MOP supply directly impact the private property market? So on average, we see about 10 to 20% of people, once they hit their MOP, they are looking to upgrade, right? So I like to explain MOP supply essentially equates, right, as a certain factor to private demand. I've also run this analysis where I put in various parameters factoring into the private property price index, and in that research and analysis is proof that MOP supply has the highest correlation to property price index increments. If you're interested to take a look at that little research, you could drop us a text. Happy to send it over to you. I'm going to put that chart somewhere in this video. So now if you see these two reasons, right, the government expecting interest rates to come off and expecting demand for private market to come up, I do think, right, they do expect prices to come up significantly. And I've also asked my clients as well as my associates this question: do you think the government will do this if they expect prices to fall? The answer is no, they do expect prices to go up. That's why they have to preemptively come in to try and control the prices. So the first two reasons explores the demand side to the private property market. Now, what about the supply side? For that, I'm going to look at the estimated TOP supply, because resale supply year on year remains thereabouts the same, right? So the real delta comes with the TOP supply. Now, this charts the estimated TOP supply all the way from 2014 to beyond 2029. The average number per year stands at slightly over 10,000 units. Okay, so and if we see over here 2025, 2026, 2027, 2028, 3 out of the 4 years has numbers below the average. Only in 2027, the number is 11,000 that is above the average over the last 14 years. Now, I'm leaning towards saying in the next couple of years, the supply isn't sufficient to meet the demand. Why? It's because if you look at 2022 to 2024, where the numbers were above the average, right, we still saw prices increase cumulative over the 3 years, 11%. Right, so in 11% increase despite numbers being above the average. Now we have 3 out of 4 years that the numbers is going to fall below that average. I do expect prices to go up even more aggressively. So if you've taken anything away from this video, please do us a favor, like and subscribe as you help out the channel a ton. Thank you very much, and now back to the video. Now let's talk about how I think these measures is going to impact the market in the short term. And when I'm talking about short term, we are talking about between 6 months to 1 year. For that, let's start off first by looking at the URA flash estimates for the second quarter of 2025. Okay, as you can see over here, right, in the second quarter of 2025, they expect price to only increase by 0.5% compared to 0.8% in the first quarter. So that's cumulative for the first half of the year of about 1.3%. Okay, and as you can see over here as well, transaction volumes are down 40% quarter on quarter. Now, you compare this price increment over the previous years. Let's simplistically take 1.3% for first half, multiply that by 2, you get about 2.6%. That's significantly lower than 8% in 2021, 6% in 2022, 6% in 2023, and 3% in 2024. This is already significantly lower than the previous couple of years. Transaction volumes are already down, essentially meaning that the market is already quite cool at this point in time, which again comes to the point why I don't quite understand why they implemented this at this particular point in time. But conclusion is, in the short term, I don't think it's going to change much. So now, how is this going to impact the market in the medium term? And we are talking about anything above 1 year to about the 5-year mark, right? I do have a concern that we may be in a supply crunch come 2028 up to 2029. The reason why is because anybody buying their property now won't really sell it until July 2029, else they'll be subjected to penalty. And if you remember the previous chart on MOP supply, right, the government is saying that there's going to be a huge pickup in MOP supply. You come 2027, 2028, 2029, all that supply and all that demand coming in and not enough enough supply in the private market to feed that, tells me that there can potentially be a sharp price increment come the middle part of 2028. And with that, I do think the government may potentially have to come in to cool the market again. Now, in the long term, the market is going to get used to this again, as they have gotten used to all the cooling measures that we have to deal with. Everyone's going to just adjust their analysis, adjust their portfolio planning to fit these perimeters. Now, how is this going to impact specific groups of people? I'm going to start off first with the HDB owners and potential upgraders. If you are looking to upgrade, I do recommend that you do so sooner rather than later. And as I explained earlier, in 2028, I do expect a supply crunch because the people that buy today can't sell to you by 2028, right? You only have the resale supply to work with and anyone that has bought prior to 3rd July this year. I haven't even talked about the fact that I do think HDB prices will revert back to the trends prior to COVID, which is that they are generally trending downwards. We have already seen prices stabilize and even come off in certain areas in Singapore. Hence the news from MND that they may remove the 15 months wait out period. Now, when that happens, if you look at the data between 2017 all the way up to COVID, private prices were going up and HDB prices were coming off. In those circumstances, actually, a lot of HDB owners were very urgent to make that jump up to private the minute they hit their MOP. And if you see it this way, right, it creates this vicious cycle of this little fork expanding outwards as, you know, HDB prices come off and private prices continue to climb because people feel that they have to do it sooner rather than later. In the last couple of years after COVID, because private prices have been climbing in line with HDB prices, a lot of people have been kind of conditioned to think that they are in no rush because their HDB prices are also going up. I feel that might change should HDB prices come off. So if you're looking to buy a private property, I would also recommend that you do it sooner rather than later for the very same reasons as what I mentioned earlier for the HDB owners. But another factor to it is that I think that this particular cooling measure will impact the supply in the market as well. Why is that so? It's because if you remember last year, where there were a lot of blockbuster launches, you also noticed in the sub-sale market that there was a lot of supply, and a lot of those supply were priced very attractively. Why? Because the owners were looking to just let it go so that they can roll their investments into another blockbuster launch. Okay, with launches in the RCR and OCR dropping significantly, and also with the fact that if they were to roll it now, that the next one they will have to hold for 4 years. Some of them may not be so incentivized anymore, and if they are not so incentivized anymore, they may then just jack up the current prices of what they are currently holding. If not, they may not even sell at all. All this will kind of impact the current resale supply in the market, and in the end lead to increase in prices. So if you can find something that kind of suits your budget, something you can rationalize the price with, I do recommend acting on it sooner rather than later. Now, if you are a seller of a private property, and especially if you are selling to right size down, then there's no need to rush, there's no need to be concerned, because I feel generally prices will go up instead of coming down. Now, lastly, if you are a private property upgrader looking to upgrade, especially into the landed segment, again, you will want to do it sooner rather than later. The reason being, okay, for the landed market, the price leaders are the developers, okay? So the developers, there are two kinds, right? One that buy with the company name, they pay their ABSD and whatnot, right? So those are not subject to SSD. The other kind of developers are those that buy in their own names, and then they have to serve out their SSD in order to sell, right? So whatever you see in the supply in the market right now, they are still subjected to the 3-year SSD. 3-year SSD also means lesser holding period, lesser sunk cost from the developer's part. Now, if you are looking to buy anything that the developer buys from now onwards, they have to hold it 4 years before they sell you. If they want to sell you earlier, they're going to factor the SSD percentages into it. All in all, simply brings about an increase in landed prices. So again, if you're looking to upgrade into a landed, do it now where you can buy the current supply at the current prices, because future supply, future prices are only going to be higher. So in summary, I believe this adjustment of the seller's stamp duty will lead to a shrinkage in supply in the sub-sale market in the short and the mid-term, and likely by 2028 we will see a sharp price increment. Now, this sharp price increment may not be the same across all segments of Singapore. In particular, I feel the RCR and the OCR will see a sharper price increment as compared to the CCR, for example, because that's where most of the MOP upgraders will go. Now, that being said, I feel an imbalance happening because I'm starting to see some of the prices in the RCR and the OCR matching up very, very closely with the CCR. And I've kind of summarized that in this particular video. Please do check it out. If you have time, I'm putting the link somewhere in this video or somewhere down in the description. And we have already assisted our clients to narrow down to the areas that I feel will benefit from all these imbalances and all this confusion and noises in the market. If this is something that interests you, feel free to reach out to us, or if you'd like to take a look at any of the research that we have done in this video, similarly, feel free to reach out to us. We are always happy to share. So if you resonate with our systematic data-driven approach and would like to utilize that for your own purchase, property planning, upgrade, feel free to reach out to us. We are happy to help you out. If not, till next time, bye-bye.